Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Kimberly-Clark stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Kimberly-Clark is a personal care company that produces mostly paper-based consumer products. The company is headquartered in Dallas, Texas, and was founded in 1872. It went public in 1968 and trades on the New York Stock Exchange, Xetra, Deutsche Börse, Swiss, London Stock Exchange, Vienna, and Mexican Bolsa. It manufactures sanitary paper products and surgical and medical instruments. Its brand name products include Kleenex tissues, Kotex feminine hygiene products, Cottonelle, Scott and Andrex toilet paper, Wypol utility wipes, Kim Wipes scientific cleaning wipes, and Huggies disposable diapers and baby wipes. Let's get started with the model. This is a large cap company, 45 billion market cap. They're trading at $133 a share and they have 337 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see their free cash flow is pretty consistent, $2.1 billion in 2018, and it was $2.2 billion in the trailing 12 months. It did peak in 2020 at $2.5 billion. Net income is the profit and loss on the income statement. It's revenue minus expenses. And that jumps from $1.4 billion up to $2.3 billion. And their revenue is pretty consistent from $18.5 billion up to $18.9 billion. It peaked in 2020 at $19.1 billion. They had their most sales during COVID in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. Their gross profit peaked in 2020 at $6.8 billion. It's currently $6.6 billion. Below that is operating expenses, and then below that is operating income, which is $3.1 billion, a little lower than 2020 of $3.2 billion. They pay between $250 and $260 million of interest on their debt each year. Then below that is other income and expenses. This is usually impairments or write-offs. They received $143 million of earnings from equity interest. This is the company's earnings from its investments in other companies. And the bottom line of the income statement is their net income, which was the highest in 2020 at $2.4 billion. It's $2.3 billion in the trailing 12 months. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. Their operating cash flow peaked in 2020 at $3.7 billion. It's $3.3 billion in the trailing 12 months. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And their free cash flow was $2.2 billion in the trailing 12 months, a little lower than 2020 of $2.5 billion. Since they have so much free cash flow, they pay about $1.5 billion of dividend payments. They also use their free cash flow to buy back stock. They bought back $800 million in 2018, then another $800 million, then $700 million. Every time a company buys back stock, that decreases the shares outstanding, making your shares more valuable. It looks like they added about $1 billion of debt in 2020, since they issued $1.8 billion of debt and paid down $850 million. You may be wondering why they added so much debt when they have a lot of free cash flow. When a company adds a lot of debt with sufficient free cash flow, it's likely they're acquiring another company. Let's look at the capital structure. $500 million of equity, $8.8 billion of debt. They're 6% equity, 94% debt. Their WACC is 5.6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that $74 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $67 billion. We divide that by 337 million shares. And we get a calculated stock price of $198. They're trading at $133, so they're trading at a 33% discount. It's a strong buy according to the model. Simply Wall Street is really close to me. They're at $194 a share. They're also saying the stock is undervalued. 8 analysts priced this stock and the average price target was $140. The low was $123. The high was $159. This top chart is the stock price since it started trading, and it looks like the stock pretty much has gone up overall. There was some dips here and there, but the trend is pretty much up. In the past year, the stock hasn't done too well. It did peak in the middle of 2020 at $160 a share, but it's come down since then. It's trading at $133. They seem to raise their dividend each year. They were paying 92 cents a share in 2016. It's up to $1.14 in 2021. They pay a 3.4% dividend yield. They pay out 68% of their net income and 70% of their free cash flow. Their industry pays a 2.4% dividend, so they're paying more than their industry. Analysts are forecasting their dividend to grow to 3.6% in the next 3 years. They have a pretty low beta, 0.52, so the stock moves half what the market moves. The stock has gone down 2% in the past 52 weeks, while the S&P 500 went up 40%. The 52-week low was 128, the high was 160, and the stock is trading below its 50-day and 200-day moving average. About 2 to 2.5 million shares are traded each day on this stock. Of the 337 million shares outstanding, 336 million are on float. 76% are held by institutions, and 2.5% of the shares are shorted. In the past year, this stock has only gone up 1%, while its industry went up 19% and the market went up 48%. In the past 3 years, this stock has gone up 40%, its industry 95%, and the market 61%. In the past 5 years, this stock went up 23%, its industry 94%, and the market 126%. So this stock has lagged the market and its industry. Analysts are forecasting their earnings to grow 5%, its industry 4%, and the market 15%. Analysts are forecasting their revenue to grow 3%, its industry 3.5%, and the market 9%. In the past 5 years, their annual earnings increased 5%, whilst industry increased 12% and the market also increased 12%. In the past year, their earnings decreased 4%, its industry increased 41%, and the market 19%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $28,000 today. That's 11% annual return. The biggest shareholder is Vanguard at 8.2%, then BlackRock, State Street, MFS Investment, and Geode. Let's look at their financial ratios. The average PE in the market's 33, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 19.7, so investors are paying $19.70 for $1 of earnings. That's a really good PE ratio. Price to sales is 2.4, also another good ratio. Price to book is 86.6. And the way you calculate price to book is stock price over book value per share. To calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities in the balance sheet, and they have $518 million of equity, negative $2.1 billion of tangible equity, because they have $2.6 billion of intangible assets on their balance sheet. They have a really bad price to book ratio because they have so much debt in their balance sheet. Their return on invested capital is 26.8%, interest coverage ratio of 12.2, and their ROE is through the roof, 439%. That just shows you how you can inflate your ROE by taking on a lot of debt. They can cover 80% of their current liabilities with their current assets, and their current assets are $300 million of cash, $2.2 billion of receivables, and $2 billion of inventory. So they do seem undercapitalized. They had $2.2 billion of free cash flow, negative $1.6 billion of working capital, plus they paid a $1.5 billion dividend payment. So they're short about $900 million. So it looks like they're going to need more debt financing to run their business over the next 12 months. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 4 other companies in the same industry as KMB. And if KMB has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in PE and price to sales. They're doing terrible in price to book. They have a bad current ratio. Their ROE is through the roof, but they're really high in debt. And they're the biggest company on this list at 45 billion market cap. The average is 14.9 billion. And they also pay the highest dividend. So to summarize, I have them trading at a 33% discount, but this company has been around a really long time, almost 150 years. They have some really popular brand names, so they're definitely not going anywhere. They bring in a lot of free cash flow. I rank at 7 out of 10. I rank their revenue 8 out of 10, and I rank their ratio 6 out of 10. Plus you get that nice dividend yield. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.